YouTubers! Mike Martin's here, Mike Martin's channel. Guys, thanks for joining me. Thanks for subscribing and thanks for sharing my stuff. Sydney house prices dropped the most in 30 years since 2017 peak. That's 3 decades. Most of the people watching this weren't even around 30 years ago. What is happening, people? Sydney's property market slump has reached a new milestone with, well, they're not achievable or great milestones, but let's see what's happening. With values falling further than the late 1980s when Australia was on the cusp of entering its last recession. Oh yeah, I'm going to spend $2 million in Sydney for a bungalow. And I'm going to go to a party and tell everyone how I bought this piece of crap bungalow for $2 million bucks. And people that didn't buy, I'm just going to tell them how bad they are for not buying. And oh yeah, and wives going, I'm going to divorce my husband. He doesn't want to buy in this market. Everyone's buying it. Everyone's looking bad at me and my friends. And now I don't own. And then I look, well, good. Isn't it good that you listened? And here we go. Average Sydney home values have fallen 10.1% since their 2017 peak. CoreLogic head of research Tim Lawless said on Tuesday, citing data of December 7th, that surpasses the top and the bottom decline, 9.6% record between 1989 and 1991. Holy AD, that is AD. The declines in Australia's biggest city are accelerating as tighter mortgage lending standards by the banks limit the amount of people can borrow, and nervous buyers sit on the sidelines while policymakers are monitoring the market closely. None appear nervous of an outright crash. Well, you know, you got the Royal Commission in there sniffing around. I think the Royal Commission should have been in place since the time of Moses, but no, it wasn't. And now, I've been talking about this Sydney and Melbourne and all of this Eastern Australia fiasco, shenanigans, or cockamaniac for years now. Now you got all these Captain Obviouses coming out and saying, hey, you should have done this, and you should have applied this, and then you should have raised interest rates at this point. Oh, whoa, Captain Obvious, we know that. And I've been talking about this for years. Sydney was the epicenter of a 5-year boom. Prices are still more than 60% higher than they were in 2012. That means a few existing homeowners are underwater. And the big 4 banks, which dominate about 80% of the home loan market, have plenty of buffer before losses would bite. So guys, who remembers those parties, those house parties? Well, you're not being invited to those parties anymore, aren't you, if you didn't buy? Well, he didn't buy, so he's not underwater. And all the interest-only mortgages coming to fruition in the next couple of months. Woo! Still expensive. The long-term means the falls have only undergone a couple of gains, years of gains. Look at that, people. Oh, yeah. It's not looking good right now if you look at this graph. It's CoreLogic, Bloomberg. We're obviously past the cycle of the peak and the housing prices naturally coming off, Craig Vardy, BlackRock's head fixed income for Australia, said. Briefing of Sydney Tuesday, moderation in the housing market is expected to continue. Vardy said that the housing slump could be prolonged over the next 12 to 18 months, and national house prices could fall another 10%. 10%? That's going to put another 20% of people underwater. They're making it seem, it's just 10%. Go ahead and tell the mafia you're gonna cut back 10% on what you're paying them. Go ahead and tell the mob that. Separate data from Australian Bureau of Statistics on Tuesday showed Sydney prices fell another 1.9% in the 3 months to the end of September, the worst quarterly performance since March 2005. The biggest driver of the falls have been gradual tightening of the credit standards over the past 4 years. What? What? Gradual tightening of credit standards? Up until the Royal Commission showed up, they were giving away mortgages to anyone that could walk. Concerned that standards had become too lax and the market was overheating, regulators limited the number of interest-only mortgages and pressed banks to tighten security of income and expense verification. Oh, yeah, you know what? Let's check his pay stub. Really? We do that? Okay, let's see how much this guy actually makes. Can he actually pay this damn thing back? Well, that just has started happening in Australia. That's a new thing. Analysts estimate the maximum amount of households can borrow has been reduced to about 20 points. That's huge, people. Australian authorities have repeatedly emphasized that the declines are desirable as the boom was unsustainable and have suggested that the market is now returning to normal conditions. Yeah, you know what normal conditions is? 300 grand for a tear-down bungalow in Sydney. That's normal conditions, not $2 million bucks. In the latest survey of Australia's OECD, however, warned the soft landing in the housing markets are rare internationally, and the country should be ready to respond to the risk of significant price decline. Additionally, the Reserve Bank of Australia's number 2 official guy, the Billy, said banks risked exuberating the slump if they pulled back from lending simultaneously. Lending spike. Okay, this is a very important portion here of this. I got to read it for you guys here. Lending spike. Still, home loan data released on Monday surprised the upside that the value of new loans to owner-occupier buyers jumped 3.5% in October, the most since August 2015. Home loans have been a primary driver to the bank profits in a few years. So these are HELOC, second mortgages, people watching it in the West. Leading bank analysis to downgrade their expectations of future earnings. However, concerns about potential losses muted because Australia's banks rarely lend above 80% loan-to-value ratio without separate insurance policy. So there's a lot of people consuming. So a lot of people that are borrowing from their homes, they're using it to eat a meal. Because if they don't, they will probably go 3-4 days without eating. While impaired loans have edged up, they remain very low into historic levels, Moody's Investor Services said in recent report. The banks have healthy collateral buffers against mortgage losses, Moody's said. The major concern of central bank is whether declining house prices will cause consumers to cut back on spending. Cause consumers to stop borrowing from their damn homes like ATM machines. Revising the so-called wealth effect, potentially causing a knock-on decline on the whole economy. Traders are pricing in a little chance of rate rise next year, with some betting that how the next move in rates could be down. So they might move rates down, and that's going to see a collapse in the Australian dollar because they're not hedging properly against inflation. If the US and Canada go ahead and raise rates, you're going to start to see a lot of problems and a lot of turbulence in trading. And guys, don't forget to join me for Trends in the Housing Market every Wednesday night, Western Seaboard time, 7 p.m. That's like in Australia, like 2 p.m. On Thursday or something, or 3 p.m. on a Thursday. So most people are at work, but people still tune in from down under to watch the show and call into the show. Let me know what you guys think. Let me know what you guys feel. Let me know. This is a bunch of garbage. And I've been, here, see the links around me? Watch those links. I've been talking about this Australian housing cockamaniac fiasco for the last, I don't know, 5-6 years. And all these, what do you call it? Captain Obvious is, oh, we should have did this and put this in place. It's like, why are you doing this now? Oh, you're coming to tell the firefighters or the firefighters battling the flames that there should have been an extra escape ladder, and there should be an extra additional more reinforcement on the roof. And well, the building's burnt down. What's the point? Let me know. Comment below.